On July 16th, TSMC reported the best quarter in its 39-year history. Record revenue, record margins, earnings per share up 77% from a year ago, and the stock went down. If that makes no sense to you, this video is for you, because that gap between a great company and a great stock is one of the most important lessons in investing. I went through the actual earnings release, the management report, and the full earnings call transcript. Not the headlines, the documents. Here's what they say. First, the scoreboard. Revenue, $40.2 billion in a single quarter, up 33.7% year over year. Gross margin, 67.7%. Operating margin, 60.3%. For a manufacturer, those are almost absurd numbers. Most factories on Earth dream of 10. Earnings per share came in at 27.25 NT dollars, up 77%. Return on equity, 45.9%. Every single one of those is a record. So far, this sounds like a stock that should be flying. But here's your first professional habit. Check the quality of the earnings. Inside that $27 EPS, about $2.24 came from a one-time gain. TSMC sold and revalued its stake in another chipmaker, Vanguard. That's real money, but it's a windfall, not the engine. Strip it out and core EPS is about 25 NT dollars. Still up roughly 63% year over year. Genuinely outstanding. But always separate the engine from the windfall, because the market absolutely does. Now, what's actually driving this? Look at the technology mix. For the first time ever, 2nm, TSMC's newest, most advanced process, showed up in revenue, 3%. 3nm contributed 30%. 5nm 33, 7nm 11. Added up, 77% of wafer revenue comes from advanced technology no other foundry can deliver at this scale. And that little 3% from 2nm, that's not small. That's the sound of a brand new product cycle starting. And who's buying it? This is where TSMC's identity has quietly changed. High-performance computing, the category that includes AI chips, is now 66% of revenue, two-thirds. Smartphones, the business that built this company, 22%. IoT and automotive, single digits each. Read that again. TSMC is now an AI infrastructure company that also happens to make phone chips. Whatever your phone did for TSMC's last decade, data centers are doing for its next one. And management says that AI demand is broadening, not peaking. Their words on the call: the emergence of Agentic AI, AI that acts, not just chats, is bringing CPUs back into the AI data center, on top of GPUs, custom ASICs, and networking chips. Here's why that matters. TSMC doesn't need to know which chip architecture wins the AI wars. It manufactures nearly all of the leading-edge contenders. And advanced packaging, the technology that stitches these giant chips together, and is still supply-constrained. Demand is literally outrunning the factories. So with all that strength, guidance was raised. Third quarter revenue is guided to $44.6 to $45.8 billion, at the midpoint up another 12% in a single quarter. And for the full year, management now expects revenue growth, quote, slightly above 40% in US dollar terms. But, and this is the number the market fixated on, gross margin was guided to 65 to 67%, lower than the 67.7 they just printed. Margins going down? Here's what the headlines got wrong. That margin dip has three named causes: the steep ramp of 2nm, new overseas fabs coming online, and the depreciation bill from all that new equipment. Every new node in TSMC's history starts out margin dilutive. You build the factory first, and yields and pricing catch up later. This is the cost of investing in growth, not a sign of weakening demand. There's a world of difference between margins falling because customers left and margins dipping because you're building the next decade, and TSMC is building aggressively. The full-year capital budget was raised to $60 to $64 billion. And management specifically named Agentic AI demand as a reason. Follow the cash. This quarter, operations generated 783 billion NT dollars, and 496 billion went straight into equipment and fabs. So free cash flow gets squeezed today so that capacity and revenue can compound tomorrow. Foundries don't spend like that on hope. They spend like that on committed customer orders. So why did the stock fall? 5 reasons, stacked on one day. 1. Expectations were sky high, record results were already priced in. 2. That softer margin guide. 3. CapEx went up, which means less free cash flow near term. 4. Reported EPS was flattered by that one-time gain. And 5. AI valuations across the whole sector were compressing anyway. Notice what's not on that list: demand, competitiveness, or execution. This was a valuation event, not a fundamentals event. The market repriced its own excitement, not TSMC's business. So here's my honest read. Across 3 time horizons: short term, 1 to 3 months, neutral, margin noise, and sector sentiment will push the stock around, and none of it will mean much. Medium term, 3 to 12 months, bullish. The 2-nanometer ramp builds, and guidance keeps that 40% pace. Long term, 2 to 5 years, strongly bullish. This remains one of the most dominant manufacturing businesses ever built. What I'm watching: monthly revenue, gross margin, the 2-nanometer mix, HPC share, and free cash flow. The company is exceptional. The only real question is what you pay for it, and that's the discipline. A great company and a great entry price are 2 separate questions. Never let a headline answer both for you. Quick but important, this is analysis and education, not financial advice. Always do your own research before investing a dollar. If you want more earnings teardowns like this, real filings, real numbers, no hype, this is Elio Poon, AI Business and Money Lab. Follow along. I'll see you in the next one.